A mutual fund is a type of investment vehicle that pools money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. The fund is managed by a professional fund manager or management team, and investors buy shares in the mutual fund, which represent their ownership stake in the overall portfolio. Mutual funds provide a way for individual investors to access a diversified portfolio without having to directly buy and manage individual securities. Here's how a mutual fund pools funds from multiple investors. Creation of the fund. A mutual fund is created by an investment management company or fund sponsor. The fund is registered with regulatory authorities, and its structure and investment objectives are outlined in a prospectus. Fund manager. The mutual fund is managed by a professional fund manager or a team of managers employed by the investment company. The fund manager is responsible for making investment decisions based on the fund's objectives and guidelines. Investor participation. Individual investors who want to participate in the mutual fund purchase shares of the fund. Each share represents a fractional ownership interest in the overall portfolio. Diversification. The mutual fund pools the money collected from investors and uses it to build a diversified portfolio of securities. This portfolio may include a mix of stocks, bonds, money market instruments, or other assets based on the fund's investment strategy. Net asset value, NAV. The value of the mutual fund's portfolio is calculated regularly, typically at the end of each trading day. The total value of all assets in the fund's portfolio minus liabilities is divided by the number of outstanding shares, giving the net asset value, NAV, per share. Share pricing. Investors can buy or sell mutual fund shares at the current NAV. The price at which investors transact is based on the NAV at the time of the transaction. Open-end versus closed-end funds. Most mutual funds are open-end funds, meaning they continuously issue and redeem shares based on investor demand. This ensures that the number of shares outstanding can fluctuate based on investor interest. Closed-end funds have a fixed number of shares and are traded on stock exchanges like individual stocks. Their share prices can deviate from the NAV, depending on market demand. Redemption and liquidity. Investors can redeem their mutual fund shares by selling them back to the fund. The fund, in turn, must provide the investor with the current NAV per share. The liquidity of a mutual fund depends on its structure and the types of securities it holds. Open-end funds generally provide more liquidity than closed-end funds. Distribution of profits. Mutual funds may generate income through dividends, interest, or capital gains from the securities in their portfolio. Profits are typically distributed to investors in the form of dividends or capital gains distributions. Professional management. Investors benefit from the expertise of professional fund managers who make investment decisions based on their analysis of market conditions, economic trends, and individual securities. Regulation and oversight. Mutual funds are subject to regulatory oversight to protect investors. Regulatory authorities, such as the Securities and Exchange Commission, SEC, in the United States, enforce rules and regulations to ensure transparency, fair pricing, and adequate disclosure. By pooling funds from multiple investors, mutual funds provide individuals with access to professionally managed, diversified portfolios, even with relatively small investment amounts. This structure allows investors to benefit from economies of scale, professional expertise, and risk diversification. Additionally, the ease of buying and selling shares makes mutual funds a popular investment choice for a wide range of individuals.